Hey everyone, welcome back to the channel, which is all about income-oriented investing, how to generate passive income from a diversified portfolio of high-yield funds. And speaking of high-yield funds and high yield, how does 60% plus yield sound? Pretty crazy, right? Pretty impossible. Well, not so much, because today I'm going to review two brand new ETFs from YieldMax ETFs. The YieldMax Innovation Option Income Strategy ETF, stock symbol OARK, and the YieldMax Tesla Option Income Strategy ETF, stock symbol TSLY. And so far, two distributions have come out for these two ETFs, over 60% yield. Pretty crazy. So how are they able to sustain or generate such high income from Tesla and from ARK? Another thing to remember is that these are just two that are out. There's another 13 coming. So let's do a deep dive into these two ETFs. Let's analyze the strategy, see what these ETFs hold, and try to really understand how they are able to generate such high monthly income. And after that, we'll talk to the guy who actually manages and writes the calls for these ETFs so we could get all our questions answered. As usual, if it's high yield, I got you covered. So let's get started. All right, everyone. So as usual, if you want the information, the correct information, we always go to the fund's website. So here I am on YieldMax ETF's website. This is a brand. The actual website is elevateshares.com/YieldMax. And I know it could be a little bit confusing. You know, what is the actual name or the company behind these ETFs? And guess what? I will ask the sub-advisor or the guy who actually writes the calls a little later in the video. So stay tuned for that because we're going to hear it direct from the manager. So let's do a deep dive on the Tesla one. So if we click on the Tesla one here, this is the website here for the Tesla. So this is the YieldMax Tesla Option Income Strategy ETF. So option income, obviously, it's going to be a covered call type strategy. And you could see here that the current yield is over 60%, which is pretty crazy. If we just scroll down, I just want to show you the dividends that have been declared. Sorry, it's right here. So a 99-cent one and a 90-cent one. And these are monthly. So if you just take the lower one, 90.29, and calculate, you know, the annual yield, if let's say this dividend remains the same here or approximately 90 cents, we'll even take the lower one. So this ETF right now is currently trading at about 17.37. So of course it's monthly. So we do times 12. And then we divide it by the stock price of approximately 17.37. If we do times 100, and bang, there you have it, at 62% yield. So how is this possible, everyone? It's pretty insane. Well, we'll take a look at it together. So if we actually look at what this ETF holds, I mean, that's the first thing we got to look at. Of course, yes, the management fee, so 0.99% here. And this is the guy who I'm going to speak to a little later in the video. Mr. Jay Pestichelli was very kind enough to talk to me fairly quickly. Didn't take long to book the Q&A, and we'll talk all about these ETFs and this strategy. So stay tuned. But first, I want to try to make you understand what exactly, you know, how these ETFs work. So if we scroll down, we'll actually see the holdings. So what does this ETF actually hold? You'll see right off the bat that here 46% or just under that, 45%, so over 90% here is in United States Treasury bonds. So this is just government debt. You also see a big chunk cash and other 8%. So almost the whole fund you see here is invested in government, you know, debt. Why is that? Kind of reminds me of SFOL a little bit. Well, it's because the rest, they don't actually own Tesla stock directly. So a typical covered call strategy, this is not actually a covered call strategy. It's a synthetic covered call strategy. So what does that mean? Well, they don't actually hold Tesla stock. They're getting exposure to Tesla stock by buying a long call. And here's the call option. You see that it expires in mid-May. And they're also selling a long put option simultaneously. No, sorry, this is the call option. It's this one here. So here's the put, here's the call. So they're selling a put. And you can see the dates match here, right? May 19th. So they're buying a long call, they're selling a long put. So this is giving you exposure to the price of Tesla. So they don't own Tesla, you're getting exposure to the price of Tesla. So if it's a bit confusing, stay tuned. I'm going to speak to Jay about that. But basically, it's just another way of owning or capturing the price movements of Tesla. And then they're going to write call options on Tesla. And the reason why they have such a big chunk in government debt here is this. That's the collateral for the options, because since they don't own the Tesla stock, there's no collateral. So you got to have collateral when you write those options. And here's actually the options. This is where the premiums, or where the money gets made and gets generated. You see the date here of this call. So it's a Tesla call at $115, and it's expiring 4 days from now. I'm filming this on March the 6th. So they're owning Tesla synthetically by buying a call, selling a corresponding put, and selling call options to generate the monthly premium. So that's basically what's inside this ETF. If we look at the prospectus, so once you're on the Tesla website here, on the Tesla one, you click on prospectus, and this is where you get all the information. And the Tesla starts at page 92. So I'm gonna take a look at this a little bit later. So Tesla, this ETF is just one of the 10 single stock ETFs that's coming here. So if we scroll down, you could see here that the fund strategy will cap its potential gain if Tesla shares increase in value. That's typical of any call option or cover call strategy, right? You're capping or you're reducing your gain if Tesla goes up, and the fund strategy is subject to all the losses if Tesla shares decrease. So very typical language here for a cover call strategy. If there's a bull market and the shares go up, you're not going to get maximum value, but if it goes down, you're capturing the full value. And it says here, which may not be offset by the income received, but it definitely offsets some of it, right? So the fund does not invest directly in Tesla. I kind of touched on this already. Fund shareholders are not entitled to any Tesla dividends. Tesla does not currently have dividends, but the other 9 stocks, there's Apple in there, for example. So if when the Apple one comes out, you wouldn't have access to those Apple dividends or those Microsoft dividends. I think Microsoft is another one. So let's just go down and read here what I feel. I highlighted the important part. So synthetic covered call strategy, what does that mean? So a traditional covered call strategy is an investment strategy where an investor sells a call option on an underlying security it owns, right? That's why it's called a covered call. It means you are selling calls on something you own. But a synthetic covered call strategy, which is what this does, is similar to a traditional covered call strategy. However, the investor does not own, so in this case, Tesla, but it seeks rather to synthetically replicate 100% of the price movements of the underlying security through the use of various investment instruments like we just saw. So they're going to buy a long call, they're going to sell a corresponding long put, and that will basically give you synthetic access to Tesla shares, basically, or tracking the price movement. So if we scroll down, let's take a look at the covered call writing, because as we know, it's important to know the moneyness of the calls. Are they writing at the money, out of the money? So they are writing 5 to 15% above the current Tesla share price. So it's 5 to 15% out of the money calls, everyone. So these are not very super aggressive calls. They're out of the money, but we know that for a stock that's very, very volatile, it's going to harness a lot of premiums, and then it holds U.S. Treasuries as collateral in connection with the fund synthetic covered call strategy. So that's basically it. If you look at it here, if we look at the principal holdings and strategy, and it's like I discussed, right? They're purchasing call options, at the money call options, to get exposure to Tesla price movement. They're gonna sell put options as well. And that's going to basically, so these two here, that's going to give you access to the price movements of Tesla. So it's almost like a synthetic version of owning Tesla stock. Then they sell the call option. This is, the 5 to 15% out of the money call. So this is what generates the big monthly premiums. And these are going to be 1 month or less. So they're short calls, whereas these ones are long call, long puts. And then there's the U.S. Treasury securities, or the U.S. bond. So that's pretty much it. And this is the same type of strategy. So this synthetic covered call strategy that we just went through is going to be the same for all 15 of these ETFs that are going to come out. 2 of them are out. And if we look here, these are the ones that are, about to come out here. So Tesla is the only one that's out right now. But if you look at all of them here, the prospectus covers all of them. It's all the same strategy. It's all the same language. So we have an Apple one coming out, Amazon, Berkshire, Coinbase, Meta, which is Facebook, Google, Netflix, Nvidia, Block, and of course Tesla, which is out. So these are 10 single stock ETFs where they're basically synthetically getting access to the price movements of the of the single stock, and they're getting covered call. They're generating high covered call premiums. Now, OARK is the other one that's out. This is actually not on a single stock, but it's on Cathie Wood's ARKK ETF. So it's the same exact strategy, everyone, but they're doing it on, instead of Tesla shares, they're doing it on ARK, Cathie Wood's ARK ETF. If we open the prospectus, it's pretty much going to be the same thing. You see that OARK is right here. And there's another 4 that are going to come out as well. So they're going to come out with the same thing, same strategy, 4 other ETFs: KWEB, GDX, XBI, and TLT. TLT might sound familiar. So if you're curious, let's check them out really quickly together. So obviously OARK will focus on ARK, which is Cathie Wood's flagship fund, and believe it or not, the first the main holding is Tesla. There's also Zoom, Block, which is a Coinbase, which is one of the here's Block and here's Coinbase. So this ETF holds all innovative stuff, all things to do with innovation, and the strategy is the same. Then there's also KWEB. That's this one here. This is the China Internet ETF. So this is going to be all Chinese technology companies here, with the main the big 2 holdings is, let's see here, holdings Technet and Alibaba are the 2 main holdings, which make up about 20% of the fund. There's also GDX, which is gold miners ETF. So this is going to be gold producers, and in main holdings, of course, you'll recognize Newmont, Barrick Gold, Franco-Nevada, just the big guys here. It's an index-based one. XBI is a biotech ETF, so all biotechnology companies. And then TLT, of course, is the 20-year government bond, which iShares came out with TLTW, which is kind of a very, very similar cover call strategy, and they kind of beat them to it, I guess. So very, very interesting stuff, guys. And now that hopefully you understand the strategy, let's talk to Mr. Jay Petricelli so we could finally figure out and put all this information together. All right, everyone, welcome back to the channel. I have a very special guest today, Jay Petricelli from ZEGA Financial, who is the sub-advisor who actually manages these brand new really high yield ETFs, which of course you guys know I'm a big fan of, OARK, and which is the YieldMax Innovation Option Income Strategy ETF, and of course TSLY, the Tesla one, the YieldMax Tesla Option Income Strategy. So Jay, thanks so much for doing this. Welcome aboard. How's it going?
Great, Adrian. Thanks for having us on. I love talking about these strategies. They're so unique. So happy that you're willing to give us a little time on it. Thank you.
It's my pleasure, and hopefully we keep it under 7 hours, because I could talk to options guys like you indefinitely, because it fascinates me. So let's just start with an obvious question that I pretty much had when I started doing research into these ETFs. So I got a little confused right off the bat, because you see title ETFs, then there's elevateshares.com, then there's Yield Maximizer, then the there's an advisor, Toroso, and then ZEGA is the sub-advisor. So can you just break down who actually owns these ETFs, or is it like a partnership or anything like that? Can you just explain that?
Yeah, absolutely. So Title and Title/Toroso, they're the advisor on the fund. That's the trust of the fund. That's the company that issues the fund and administers the fund. They're the kind of the main umbrella for this. And then ZEGA is the sub-advisor that actually trades the fund. So my firm, we actually are the ones pushing the buttons, buy, sell, roll options, those kinds of things. That's our role. This is all being released under the brand of YieldMax. So while, yeah, you're right, there's a lot of different titles here. Just consider that as the branding is YieldMax, title is the advisor, which handles all the regulatory work and the trust, and then ZEGA is the firm that does the trading.
Okay, so you're the guy who actually manages the options, writes the calls, and manages the fund on a day-to-day basis, right?
Yep. Our firm does that. That's
perfect.
That's our role. You got it.
I have the right guy then. This is who I really want to talk to, the guy who actually is involved with the options and things like that. So tell me a little bit about the idea or the concept behind these ETFs. Right off the bat, I could tell they're very, very unique, because they're not necessarily your basic covered call ETF. So just give me a little bit of background on how this idea, came to be, and a little bit on the strategy of these ETFs.
Absolutely. The idea, the concept really came out of the ability for us to launch an ETF based on a single ticker, right? In the past, it was a hard thing to do, but these days now you see a lot of single ticker ETFs, and actually even on some of the funds that we are doing our strategy on, whether it's Tesla or ARK, or you can even look, I think I've seen things like PayPal and NVIDIA, right? You get the 1.5 leverage. So once that kind of ground was broken, and we didn't break that ground, but once that ground was broken, we said, okay, look, everyone's going for leverage or inverse. Why don't we bring our options expertise to the table and talk about harvesting premium, like using the options to help design a dividend embedded product where we could sell calls and harvest that, I'll call it implied volatility that's in the option market, and then distribute that out. And the idea really started with a little background there on using Berkshire Hathaway, Burke. And we looked because Burke doesn't pay a dividend,
Right.
right? And we said, well, could we run a Burke fund with call selling to generate a dividend? And the answer was sure, we can. And then we started expanding and started saying, well, if it's the function of volatility that pushes up the dividend, let's look at some more popular tickers like Tesla or the the ARK ETF. And it turns out when you look at those, the yields, the potential yields on those kinds of products are kind of unlike anything else that you see on Wall Street today, right? So, the ability to sell, 1 week, 2 week out options and use that premium to generate a large dividend that right now would range somewhere between 50 to 70%, we thought was a really compelling story. And we wanted to bring that to market.
Yeah, I mean, the first thing that pretty much got my attention was the 50 or 60% yield. I mean, there's only two distributions that have been declared yet, but you do the calculation. Okay, well, they're monthly. We times those by 12, and holy smokes, you're at 50, 60. So definitely got my attention. So when it comes to, because these are call options you're writing, right, on these funds. So when it comes to
Yep.
call options, covered call strategies, there's really two factors. And I always ask the fund managers this. There's portfolio coverage, right, on how much of the portfolio you're actually writing calls. In this case, it's just Tesla stock or ARK, the ARK stock, and the moneyness. So can you go into those two factors on the strategy, which I'm assuming, I guess we'll put the Tesla one and the ARK one in the same boat. I'm assuming, from reading the prospectus, it seems like the strategy is more or less the same on all of these.
Yep. Yeah. I'll call it the YieldMax methodology, for lack
Yeah,
of a better
yeah.
term. Yeah. So we will sell calls on 100% of the portfolio's exposure. And we can get
100%, the
into
whole thing.
the whole thing, right?
Okay, that
So
makes sense now why it's so high yield.
it's on all of it. But the moneyness part, meaning how far out of the money, right,
Yeah.
that you're asking that we sell that, that's where we'll end up as being a little unusual. There's a lot of funds that go at the money or 1 or 2% out of the money. We're going to range somewhere between 5 to 15% out of the money. And why
Okay.
we do that is we want to be able to capture a portion of the upside move in these what I'll call highly volatile tickers. You don't want to find yourself kind of missing too much of the upside. There are a lot of funds that are willing to do that, and they focus 100% on generating as much premium as they can by selling out the money calls, which always have the most time value. I'll use that term. But for us, it's important to get a little bit of a mix there. And so we will sell options that range between 5 to 15% out of the money on the underlying. And again, 100% of our exposure is covered.
Okay, 100% covered, but out, way out of the money. So, that's the thing with cover call strategies. You're losing some upside if there is upside during that option period, but you're capturing all the downside as well. So it makes sense that if you're doing it on 100, it would be way out of the money. So that makes sense to me. And another thing I noticed is that typical cover call strategies, you're holding the underlying, right? You actually own the underlying. That's why it's called covered call strategy, because if you get called away, you have the shares. But this is a bit different. You guys call it a synthetic covered call strategy, where you're not really owning the underlying, but you're owning it synthetically by buying calls and selling puts simultaneously, instead of actually owning the ARK ETF or the Tesla share. So why did you guys decide to do that.
Yeah, it's you're right. You've observed it correctly. We don't actually hold the common stock of Tesla. Let's stick with Tesla for a moment.
Right.
We use a synthetic build, which is just, a complicated way of saying we're long a call and short a put, right? Synthetic or a combo, whatever you want to call it. And the reason we do that is for kind of fund purposes. There are some regulatory requirements that when you're using a single ticker, you can't have concentration of more than 25% in a single name. So there's regulatory reasons. And so the way that we move around that is we say, okay, fine, we'll use options that require a much, much smaller amount of capital, but feel like we're long.
Right.
And so that's what really when we say a synthetic covered call, we're not really long stock, but we feel like we're long stock with that short put and long call. And then we sell those kind of covered calls, we'll call that the short call, against that long call. So think about it as we really have kind of a calendar, a diagonal spread with a call and a short put. Like there's a lot of different ways that you could kind of simplify this look, but the rationale behind it is to kind of meet the regulatory requirements. And as far as I
Interesting.
know, we're the only funds that actually create their long exposure with this at the money combo to do the covered call selling.
Very interesting. Well, in Canada, there's actually Purpose ETFs came out with these styles. They actually have one
Yeah.
on Tesla, but they actually own the Tesla. So maybe the regulations are different because they have an ETF that only has Tesla shares. They put 25% leverage on it, and then they write out of the money calls on half of the portfolio. So you guys, it's a bit different. Correct me if I'm
Yep.
wrong. There's no technically there's no leverage on this, right?
No, we don't. No, that's correct. We don't have leverage. We just want it to feel like you're long the
Yeah.
stock,
Okay.
we'll say a 1x or a 100 delta. By the way, when you do this, it leaves a lot of cash in the portfolio. These
That's what I
days we're
was
buying
thinking.
treasuries as collateral. So we're getting a little bit of yield out of the treasuries these days, as well as, having that long stock exposure. But these are not, I would not consider these leveraged at all. The target is to be, I'd say a 1.0x.
Yeah. Yeah. Okay. Perfect. And yeah, you could tell when you look at the portfolio breakdown, you see that most of the fund is U.S. Treasuries.
Yeah.
Very similar to these style of option harvesting ETFs like SVO, for example. If you look at it, it's like 80-90% in treasuries, and that's what I kind of fully understood, because you see your call, you see your put, and then you see the actual call where you're generating premium. So there's those three elements, and the rest is just U.S. Treasuries, right? So I'm assuming that interest rate, which is very strong right now, the interest rates are going up. I'm assuming it part of the yield is because of those treasuries or that cash that's sitting there.
Yeah, sure. Yeah, for sure. We're getting, we're earning yields, we're clipping coupons, right? Those kinds of things
Yeah,
there. But you're right, that is a piece of it at, let's just round to these days at about 5%. We're short duration, right? We don't want to take any long duration risk. We're keeping it. I think we've got 1 year and, less than an 18-month bonds in the portfolio. We don't want to take a lot of duration risk there. So yeah, but we're definitely earning some yield on those. And at 5%, that is almost a 0.5%, that we're looking at per month within some of the yield that we distribute. Absolutely.
super interesting. And my next question, you're probably not going to be surprised. It's probably, sorry, my cat. I just got a cat a couple of days ago. The sustainability of these really, really high dividends and yields, right? So obviously, when it comes to options, the more volatile something is, the more rich the options are. So it was not really a surprise to me. We'll discuss this a bit later, but right now the OARK is out, the Tesla one is out, but there's a lot more coming. And there's 10 single stocks, including the Tesla. I think Nvidia is there and Meta is there. And what I could tell, it's pretty volatile stocks, and even ETFs. There's like a biotech one, a small cap real estate one, junior miners. So right away, I'm like, well, this is really volatility harvesting. So what would you say on people who are worried about the sustainability of these high dividends?
Yeah, so you got it right when you said the dividend is driven by the volatility of the underlying stock. We call that the implied volatility of the options chain. And when you look at, say, a Tesla or an ARK, their implied volatility is in that 70, 80% range. And so as long as that stays elevated, then you're able to deliver the covered call premium that you earn. And it really is entirely driven, the yield is entirely driven by that number. If for some reason we call it the IV, was to drop on Tesla to say 30 or 40, then the yield would drop as well. Those two numbers are going to be kind of tied very, very closely together. So the
Yeah.
sustainability of the yield is based on the volatility of the stock. I think there's a lot of folks that feel Tesla will remain volatile for quite some time. That's probably accurate. Now, as far as the other funds go, you're right. We did file for 15 different tickers. These were the first two that we launched. I think in the middle of March, you'll start to see a few more. If this is on by then, there will be a handful of others that we plan on launching. You're right. You rattled off a few of the names. I started out telling you we looked at Berkshire Hathaway as well, and that is in our list of names. And so, I think we'll continue to go. The market certainly has been welcoming to these products. Right, we're seeing volume pick up every day, and I think you're right. It's the yield that's really driving the attractiveness to these kind of funds.
Yeah, yeah, and yield is all about, what my strategy is all about, and just maximizing your income in the safest way possible. So people, correct me if I'm wrong here, people need to understand that this is not really a Tesla strategy, Tesla long strategy or ARK long. This is really, the strategy is really harvesting the volatility of these stocks and you have or ETFs, and you have to expect varying distributions. You can't expect volatility starts going down. Let's say Tesla in 5 years becomes, a much more boring value stock, which I kind of doubt for 5 years if Musk is still around.
Yeah.
But we could expect the distributions to go down. But it's really about harvesting that volatility while still participating, kind of in Tesla or ARK. But correct me if I'm wrong, I think that's more secondary, right?
Yeah, you're right. The focus is yield, 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 and then number four is upside capture, upside participation. But you don't want to miss out too much on that, right? That's also still important. And you're
Yeah,
right. This isn't look, a covered call generally means you're bullish, right? But you're trying to earn premium. Any covered call strategy that we learned in Options 101, it's the first strategy everybody learns about. You're still generally bullish, but you want those calls to expire worthless, so you earn your premium. That
yeah,
really is the most important part to us. And I do think it's worth mentioning that, I wouldn't consider these to be hedged products because we carry the volatility of the underlying ticker. And while we might, mute that volatility a little bit because, we're selling calls on the way down and you're earning a little income, you still take that kind of a risk. And so when I think about, the use case for these kinds of products, because they're so unique, I think about two different things. One, they could kind of fit into, as what you like to talk about, into a portfolio of ETFs that deliver yield. A nice, even a small allocation to, say, a portfolio that's yielding 4 or 5%. When you throw in a 10% slice that yields even just 50,
could
you push
boost.
up your
Yeah,
yield of the overall portfolio. So you can use them even though they're volatile, but you manage your risk on how much you allocate out of the gate, right?
right.
The other growth use case that I've seen some folks do is reinvest those dividends, right? So you'll end up, expanding your share count rather quickly. This is, compounding math very quickly, where, if even at just 60 or 50%, you're doubling your shares in 15, 16 months. And
Yeah,
so
it's
you can use it as a growth strategy as well, even if it's yield but growth, which is a weird, combo, but that's what happens when you have this kind of a kick out of cash.
You know what? I'm super happy you said that because I say it all the time on my channel. If you want growth, you could just drip. If you turn a drip on, you're literally turning your income strategy, your I sometimes call it a cash cow strategy, into a
Yeah.
growth strategy, but you're not, primarily growing with compound interest, the compounding effect, not necessarily stock appreciation. And that's another cool hybrid strategy too. You don't have to go all in on income or growth. You could kind of do a little bit of both. And that's why I love things that pay income, because things that don't pay income, You can't, there's nothing you could do. It's just you have to grow, you have to buy low and sell high. But with these, you could take the cash when you need it, you could turn the drip on, turn the drip off, take the money, reinvest it in something else, or just drip that one, and it'll cause a growth effect. So very, very interesting. And I'm just curious, what's your background when it comes to options? Are you like an options a specialist? Is your firm a specialized with options?
Yeah, so ZEGA is a registered investment advisor, and we run a lot of options-based strategies. Actually, every one of our strategies has options involved in it one way or another. We've been around since 2011, and yeah, everything that most of what we do is a lot of individual account management. We recently again got involved with the options side in the ETF world with our partnership with Title, but generally speaking, we're an options shop, right? There's 4 or 5 of us that trade options in our portfolios every day, and the combined options experience at Zega Financial is over 120 years. So we bring quite a bit of experience and hands-on time to the table, so to speak.
Fantastic. That's exactly what I want to hear from my options specialist, right? Lots of experience, and you guys, it's a core competency basically, which was
Oh
what I
yeah,
heard.
this is absolutely our focus, no doubt about it.
Last question. I don't want to keep you for too long. I'm sure you're busy. You got to write those calls. Uh, when's the ETA, or I know sometimes you guys are not really legally allowed to say dates and stuff like that, but the other one. So there's 15 total. There's 10 single stock tickers right now. Just the Tesla one is out. There's 9 other ones, and I'm going to show it in the video, which I'm going to do introduction. But then there's 5 ETFs as well. ARK is one of them. There's 4 others. Do you have an ETA? Is this like a gradual thing, or?
Yeah, so well, you're right. I can't give you a specific date. Plus, you know how things can go. You never want to be off by a day or two. But I think it's fair to say that you should expect to see 2 more YieldMax funds in the month of March, and I think we'll continue to look at adding more to the mix. I think we'll try to bring some that change up a little bit of the use case. Right. I think we've got 2 really great volatile tickers today that have higher yield. I think we'll start to brings some other to the table that have maybe less, stock risk, stock volatility in them for a little more of a conservative investor, but still have, a higher yield. And like you astutely pointed out, it's all based on the volatility of the underlying ticker, right? So,
Yeah.
it's you could almost, do the math on that, whatever the volatility is in the option chain, because we're a little out of the money, you just subtract a little bit, and that's generally what we plan to deliver as far as the yield. So, that's the way that the math works. And specifically, I believe you'll see a few more in the month of March from us.
I'm super excited. I love these kinds of products. They're very unique. They're cash generators that you could use them in every which way. So, Jay, I hope you come back. It was a pleasure speaking with you. A lot of great information. Thanks so much for coming and explaining the strategy behind it. And we'll definitely keep a lookout on the new products that come out. So thanks again.
You got it. Thanks, Adrian. Great to be here.
Hey, don't go yet. I have some important reminders, including some more recent ones, and I'll try to keep it as brief as possible. And for everything that I'm about to discuss, the links and info are in the video description below. So first of all, if you didn't know yet, I do offer a one-on-one coaching session where you'll have a 1-hour Zoom call with me where you could ask me all the questions you want, and I'll help you and assist you best I can. Just remember that I am not a licensed or registered financial advisor or planner. So to book a session, go on my website, passiveincomeinvesting.ca, and right there on the homepage on the left hand side, there is a small video. Watch that video to know how to book a one-on-one properly with yours truly. Also on my website, you could purchase my digital product, the Ultimate DIY Investing Package, which is on version 4 right now. It comes with lifetime updates, so you only have to buy it once. And this is really a reference tool or a companion tool to help you build your own portfolio according to your needs and your objectives. It has lists of funds, it has sample portfolios for both Canadian investors investors and American investors. So make sure to check it out on my website. I actually created a video which shows the product from A to Z, because I don't want you to spend money unless you know exactly what you're getting. So make sure to check that video out on my website. And don't take my word for how good it is. Check out the reviews. There's over 300 of them, and they are all 100% real reviews. So here's some more updated news or recent news. I am now on Blossom, a new investing app designed for investors. I've been using it for a few weeks now. I think it's really, really great. It has a really cool feature where users could actually add and share their portfolios and what they're buying and selling every day. So you could actually link your investing account so it's updated automatically on a daily basis. I recently added my own main portfolio so you could follow how my portfolio is doing live and what I buy every month. Really, really cool. It's like a mix of Facebook and Twitter, but specifically for investing. So get on your phone, click on the link in the video description below and download the app. It's 100% free, so you too could share your portfolio. Just remember to look for me and follow me. My username is Adrian, PII altogether. Also, I do have a referral link for Questrade, so you could get $50 worth of free stock purchases. This is the Canadian discount broker that I use and I recommend. Unlike Wealthsimple, the other popular discount broker in Canada, you could drip everything you want. It has all the stocks, and it also has dual currency accounts. Very, very convenient if you're buying both Canadian stocks and American stocks. I have a Questrade video, by the way, which gives you a little tour of the features, so make sure to check that out. I also have a referral link for PASSIV. This is the portfolio tracking tool that I use to consolidate all our accounts to get a nice bird's eye view, so you can consolidate all the information together for easy tracking and stats as well. Also, our Facebook group, Passive Income Investing, is now an invite-only private group. So to join it, you need to click on the link in the video description below and give the group a like to get invited. So we take pride in making this one of the best investing Facebook groups out there with over 13,000 members. There's no scams, there's no spammers, and negative and doomsday people, we kick them out right away. Also, follow us on Instagram if you want a little bit more of our personal journey here in Panama. And lastly, just remember everyone, I am not a licensed or registered financial advisor. This channel is all about my personal investing journey and how I invest to generate high passive income from a diversified portfolio of high yield funds. It's for educational purposes only, so don't forget to do your own research and due diligence. And of course, stay safe everyone, stay healthy, and of course, stay passive. See you next time.